So welcome to this call regarding infrastructure investments. We have with us today Charles Dupont, who is head of infrastructure financing at Schroders. He's based in Paris. And from Stockholm, Johanna Strömsten, portfolio manager real assets at Alecta. Welcome.
Thank you.
Thank you.
I was thinking that we could start by introducing, well, first of all, Johanna, you can have like a short introduction on Alecta and what you are doing within infrastructure, and also your experience so far with your investments, because you've been investing in this asset class since 1.5 years back, something like that, right? So if you could start by just a brief introduction.
Yes, so my name is Johanna Strömsten, and I work as a portfolio manager at Alecta in the real assets department. As you mentioned, we have been focusing on infrastructure for just 1.5 years ago. Before that, we had an allocation to real assets within purely real estate. So we have a direct department and an indirect department. And the indirect department is mainly in the outside of Sweden, and the direct department is more in Sweden and in the Nordics. So for 1.5 years ago, we got a recent mandate from our CEO to invest in infrastructure. And at that point, we decided that since we were new to space, to take sort of a step back and explore what we had and who we knew beforehand, given that some of these managers that are focusing on real assets are also focusing on real estate officers. So we know quite a lot of the managers already. So we started off meeting them and then continue meeting a lot of other managers. So I think in just about a year's time, I probably met over 100 managers in different sectors and geographies. And after doing that, we started, or we find out our first investment that we did back in October. It was a European mandate, very diversified infrastructure fund. And then the beginning of this year, we also invested in a value add fund focusing on the European and North American space. And just 1 day ago, we did our third investment in a global so-called supercore fund. So our strategy is to start off focusing mainly on funds and co-investments. The co-investments is an important part for us because that's a way for us to blend our fee structure and to be more efficient, and also to target different sectors and geographies.
And Charles, a quick intro from your side, what you are doing on the infrastructure side.
Okay, I'm Charles Dupont. I'm the head of infrastructure finance at Schroders, and I'm also the CEO of Schroders IDA, the affiliate of Schroders specialized in infrastructure financing. It's an alternative investment fund manager based in Paris. We employ 20 people, and we are only dedicated for infrastructure investment. It's originated a team of 6 people coming from AXA, where we've been working together for AXA insurance companies. And we are now offering within Schroders our services and our expertise to a wider range of institutional investors, especially in Europe and also in Asia, where we're growing very fast. We are offering solutions for investors to access this niche asset class, and especially for those investors which in this low rate environment are seeking for predictable and resilient cash flow streams. So we have developed a number of solutions for investors, either through dedicated funds or mandates, or through commingled funds, and different various instruments from senior debt, junior debt, and equity to have access to this product, with of course a very different risk profile depending on on the nature of income you want to generate. So we have now launched this activity from scratch 5 years ago, and we have currently around 2.5 billion euros of assets under management.
And you said you were focused on Europe primarily. Was that so?
Yes, we have essentially our activity based in the Eurozone because it's the biggest infrastructure supermarket in the world, and a very important market, as you know, accounting for around 50% of the pipeline, the global pipeline. So it's a market where we can be active without necessarily being active in other markets. But we have tried to develop our activity as well in the UK. The UK is a very different market with now, because of the Brexit, other considerations, especially political considerations, which made us very prudent about this market. So we have focused most of our attention on the 10 European countries in the Eurozone, especially Germany, France, the Netherlands, Belgium, and to a lower extent, Spain and Italy. But
you're not active in the Nordics yet?
We are active. We are active in the Nordics. I have to say, the Nordics is a relatively tiny market for infrastructure. The reality that there have been a couple of years ago a wave of disposals, so M&A activity, especially in the energy sector, which made this market higher in the European ranking. But the activity in the Nordics is relatively small and, as I said, more focused towards energy and renewables, which is a great sector. But when you are aiming at building a diversified portfolio of assets and a balanced portfolio of assets, of course, you need to look out of the Nordics, as well as, of course, investing in the Nordics. I think in our current portfolio, Nordics accounts for something like 10% to 15% of our total AUM.
And your client base, is that primarily French or is it widespread?
No, okay. No, we are benefiting of the Schroders distribution network, which is global.
Yep.
And where we are mostly present those days is with insurance companies because of the type of products we are offering, which are optimal in terms of Solvency II treatments. So we have a number of European insurance companies, of course French, we are all Paris-based, so we have a strong market share in the French market, I will not deny it. But we also are present in Germany, in Belgium, in Italy, in Switzerland, and where we are growing our activity very rapidly over the last few months is Korea and Japan. But we have also some Chinese clients as well.
And I wanted to go into the question of the case for infrastructure, because I see, at least here in the Nordics, there is huge interest for the asset class, even though it's still niche. Johanna, first of all, from your side, what were you seeing as the potential for the asset class when you invested?
At Alecta, we have about 40% in equities and about 50% in credits. So we had a very high percentage of our AUM correlated to the equity or to the listed markets. So we needed to have part of the portfolio being more uncorrelated and more stable. So that was how we started off focusing on real estate. And our current CIO, Hans Sterte, he had an experience working at Skandia, focusing much on the unlisted market. He was focusing a lot on the infrastructure and on private equity and on venture capital. So he had a good experience of doing that. And when he started off at Alecta, he also brought that mindset to us, and he also saw the benefit and the need for it. So that was how we started off looking at infrastructure. And we also, of course, as a lot of other people have seen, it's a very interesting market where you have a lot of, it's a very between gap with the assets and financing, and there's a lot of equity that needs to go into the asset class to develop it, to also grow with the GDP growth, and a lot of assets have quite a poor quality as well, and a lot of financing needs, and the states and the governments have a lot of deficits, given that we are getting older and we have a demographic pressure. So we saw that they needed to start selling off some assets to bring in more capital and capex, and therefore we also saw the need of long-term perspective. And then, I mean, it's a really interesting asset class, given that yes, a lot of them have quite a high monopolistic characteristics. It's long-term cash flows, and that works very well with our liabilities. It's very secured and sort of, at least some sectors, easy to forecast. And then, you know, given that we are quite a large pension fund with a large AUM, we also need to invest quite a large chunk of money when we do investments, and that goes quite well with infrastructure, given that it's usually a lot of large projects. So that's part of this.
Charles, is this in line with what you're seeing elsewhere? What Johanna mentions here on the case for the investment?
I think we are going through an unprecedented crisis where the economy has been hit hard, and we need to relaunch investment to recreate an environment of confidence. In my view, infrastructure will be part of it, and the market conditions are therefore very favorable for fund managers with capital to deploy. There's also an opportunity for governments to direct this capital towards future projects that will change our society for the better. Fighting climate change, speeding up the digitalization of the economy. It's on these two themes that we will focus our investment effort in the very near future. In my view, it will also be necessary to prevent business failures by strengthening their equity capital, particularly in the transportation sector, which has seen the disappearance of users just because of the lockdown. And these assets remain high quality assets, I mean airports, toll roads, especially, or car parks. And they are, for example, at the heart of urban development for cleaner and more pleasant cities. So they will help us get through these challenges, and in my view, is something it's probably worth some investments and paying more attention to these kind of assets.
Mm. And what kind of solutions do you have in your product range when it comes to accessing the asset class? Are there closed-end funds, open-ended funds? What kind of ways can you actually access this through?
We are today only offering closed-end funds because we believe we should you should create an alignment of interest between LPs and GPs on the long term, but also make your GPs accountable for what they are going to deliver. So we believe the closed-end format works better for the asset class, even if we're working on assets which are income generating and very resilient. At some point, when you are delegating the management to a third parties, you want this person to report not only quarterly for the quarterly reporting, but at some point on the value creation. And we believe at some point we should put an end to the delegation. So we are working on to the closed-end format, which is very standard, and we are quite used to use this wide range of different structures to comply with local regulatory obligations or favored structures for some investors depending on their geographies from which they invest. What is different is the type of instruments you can load on these vehicles, and this is why we wanted also to develop really an expertise to clients which is not biased by the nature of the product or the solution you are offering to your clients. So while offering the wide range of product along the capital structure of infrastructure companies, we are sure we always have a solution for investors, depending on their regulatory constraints or on their asset liability management constraints or on the geographies, I mean, the sectorials, the exclusions, whatever they want. We have a solution that we can either build as a pure play product, or we can combine also some instruments, combining debt, equity, senior debt, junior debt, to offer the best solution for our clients.
Mm. Johanna, what is from your standpoint, what kind of formats do you prefer?
I think it for us it really depends what type of risk and what type of asset it is, and we are doing both core plus and value add, and I think in the value add space we prefer the more closed-end structures and also in the core plus space, because usually there's a lot of value creation that goes into those projects, and then you want it to be focused during a specific period of time, and you also want the promote structure to be linked to that, and that's more difficult in open-ended structure, and which then goes better with core assets where you're more focused on the long-term cash in and stability. So I think it really depends on our end what risk you take in and what type of asset it is, and also how mature that asset is. And how where you receive your cash flow from. I mean, if it's a regulated contracted business, and where you receive cash flow that is core, and you receive those cash flows usually for a very long time because you have long-term contracts, and that goes in much better in an open-ended structure. So I think we can do all the three of it. It just depends on the type of assets.
Okay. And Charles, you mentioned Asia as one extension of your business going forward. Is there demand for emerging market infrastructure at this point?
Yes, there is a demand, but we believe the demand is relatively limited, and for obvious reasons. If you look first at the infrastructure market as an investment universe, it's roughly 200 billion euros of funding every year, out of which 15% only is located in emerging markets. 18%, 85% being located in especially Europe and to some extent North America, which means that it's a very niche market in a niche market. So it's very niche.
Yeah.
Second, the financing of these assets in emerging countries faces several obstacles. The first one is that they are strategic assets and often remain in the hands of governments. The second is that the political risks are often too high for private financing. So most of the financing is therefore a public funding or funding backed by development agency, DFIs. For the time being, we remain focused on the needs of institutional investors seeking stable and predictable returns in a low interest rate environment. And emerging risk responds to a different pocket for institutional investors that is currently very low in our analysis and competing with other asset classes. But it's a subject that we are working on because first we have this expertise internally as specialists in project finance and a well-established track record in emerging markets. The subjects also interest us particularly given its social dimension, which corresponds well to our values.
And Johanna, I know that you haven't yet invested into emerging markets. Do you see also the political risk as one major risk that you're not willing to take in this context?
We see the risk, and I think when we started off at this space, we were more reluctant to take on political risk than we are today. I think it really depends on country and what type of sector and what type of asset it is. If it is a critical asset to yourself and to people living in the society, I mean, one clear example is UK and water. Water is very it's an asset that everyone is of course a very need for. Then you have much higher political risk than maybe other assets where you also have maybe other choices. So I think in that sense it depends. But I think for us, when we take on political risk, we want it to be a minority, I shouldn't say minority, but at least a minor part of the portfolio. We need to have diversification to do it, and we find what the sort of regulated asset gives us. We can also find in more contracted assets, or which have more contracted risk. So they give sort of the same stability and they give this secured cash flow, but without the political risk, and usually it's also higher returns. And then I think we are questioning ourselves when you talk about these regulated assets with very secured long-term cash flows, and you might have a municipality or you might have a very strong credit-worth tenant as your customer paying the making up the revenue, should that really give you a high single-digit returns or low double-digit returns? If it is that secure, I think you have to also think, well, what is the risk here, and what is the risk-adjusted return, and what is reasonable? And maybe the levels that have seen aren't the right levels for the future. And if you can bear that risk and be okay with the returns that you're giving for that type of asset class, I think you're more okay investing in regulated assets with political risk.
You often mention diversification as key when it comes to infrastructure. How has that diversification worked during the pandemic here? Has it at all been diversifying your portfolio, or how has it been?
Since we only have 3 investments today in the infrastructure assets, it has been quite difficult to be diversified. But that's why we have started off investing in funds, because, and also with sort of being global, or at least European, and then we can add maybe a North American mandate to it. We quite early on were looking at a project in Germany. It was an offshore project, and we realized quite early on that given the volumes that we need to invest, if we will have to have done that project, even if it most likely would be a great project, we have been focused on one specific risk. And if the wind didn't blow in Germany during that point, or if it's not blowing today, that would also affect our return directly or instantly. So for us, it's early on when you're building a portfolio, diversification becomes key, and that is just all the geographies and sectors. Also, when you look at how much money it goes into it, because if we're investing 200 million euros into one project, and we're continuing investing adding assets to the portfolio, it will take quite a long time for us to be diversified. So that's why we have to start focusing on funds at an early stage.
Charles, from your standpoint, infrastructure asset diversification tool, what's your view on that? From a portfolio perspective.
It's the alpha and omega of any portfolio construction. You must diversify, and the good thing with infrastructure is that you embrace a wide range of risk profile. So whether you're investing through debt or equity, you must have diversification. It's the only free lunch in finance. And the good thing is that you have assets from renewable energy to roads, airports, power grids, or gas storage assets, telecom infrastructure. So typically a risk profile ranging from the ability base to the commercial risk. In Germany to Italy, Ireland, I mean, there's plenty of things and regulatory schemes. So in our view, it's something which we must build in portfolio, which is usually difficult to do. That's why you do not improvise yourself as being an infrastructure specialist. You must have the connections to access usually assets which are mid-caps and not necessarily heavily marketed by debt advisors or sellers just because they are very local and not very well known. But it's what makes a difference between 2 fund managers. And if you just look at our statistics, we have been deploying in infrastructure debt around 2.5 billion euros over the last 5 years, making 67 investments in 10 different countries and 10 different subsectors. We just mean that we have really diversification in our DNA, and much more than we should do for a platform of that size.
You've mentioned wind power and similar. Here in Europe, at least, there is a great push from the European Commission to reinforce green infrastructure projects. From your side, Charles, how do you put this into practice to actually go into green financing in that?
I would be a little bit controversial.
Okay, let me hear.
I think the purpose of sponsoring the green energy in Europe is very good. And if you look at my post, you will see me as probably an activist for a rebalance of the energy mix in Europe.
Mm-hmm.
But the reality is that the renewable energy assets account for nearly 50% of the pipeline of investment in Europe in number, and around 30 to 30% in value. There is plenty of capital available for financing green energy assets, and as much as it's probably the segments where the IRR in terms of equity or the income in terms of debt is probably the lowest from all the markets. So there's just an imbalance between supply and demand for the sector. I don't really understand as a taxpayer why the European Union should incentivize more private investors through probably public money to invest in sectors. There's already plenty of money. We may think that maybe for supporting emerging technologies in the renewable industry and in energy generation, it might be worth maybe bridging the gap between what we think the good return for this kind of investment should be and the real level of risk and how it is priced by the market. Maybe there is a need for public money to bridge this gap. But if you look at the venture capital industry already, it has changed dramatically over the last few years, and there are more and more venture capital investors which are specialized in this kind of funding and sectors and are happy to take the risk and sponsor the economy. So really, in my view, public money should aim at other sectors, and this one probably not.
Mm-hmm. Johanna, from your standpoint, you're very focused on sustainability on your end. Your work on looking at green infra, and what are you doing on that side?
We're doing a lot when in terms of the legal work. I think being an LP, we have to start off there. So we have a DD process where we have two ESG analysts working at Alecta that are coming in very early on in the DD process, looking at the investment process and also the asset management process. Given that we have to live with assets hopefully for a very long time, we also have to make sure that the asset process will work. And they're looking at, if we're investing in an already existing portfolio, they look at those assets and go through and score them to see what the potential ESG risks are there. And then we will also look into what can they invest in long term. We have some prohibited investment criteria. One is, for example, coal, where we can't invest in generation of coal being more than 30% on each individual company, and it can't be from more than 10% of extraction of coal. Then you have all this sort of the international conventions, weapons, etc. Those more sort of the classic ones. And then we also have added on now that we want our investors to focus on the Paris Agreement and acknowledge it. And then we also want them to be able to report the CSG from scope 1 to 3, because we have we're focusing on the Net Zero Alliance agreement. We're being part of that alliance, and by doing that, we also need to make sure that our investments could follow that and make sure that we will be net zero by 2050. And therefore, we have to make sure that we also receiving the data. And we just a few weeks ago become member of GRESB, which we have been looking at for a long time, but the funds that we have been invested in haven't been members of GRESB. But we have realized and seen that it's really important that we are as a member of GRESB, because we also want to make sure that the investments that we're doing, and we're doing the investment that they will also either now or long term be a part of a member of GRESB. So we're doing quite a lot on the legal side, and we also looked at an investment a few months ago, which had been around for quite a long time. And firstly, they had Cayman structures, and since Cayman are on the blacklist, we can't invest in Cayman structures, not on holding company level and not on the underlying portfolio level. But they also had quite wide views on coal, because they were thinking that they could sort of transitioning journey from coal to, for example, biomass, or that I wanted to make sure that if they want to take that on, it could mean that companies could have potentially 100% coal for a few years, and then they will transition in, and that will be the important journey. But we have decided at Alecta that we do not want to be part of that journey. We think it's better that you close down those assets and investing in renewables directly. But then it is difficult to invest in renewables, especially in the Nordics, because their returns are very low, and you take on quite a high risk, given that we have a lot of energy in this country, and we have all the production in the north, and unfortunately the transfer from the north to the south isn't great at the moment. And I think a lot of people, at least in the Nordics, have read about that the prices in the south of Sweden are much higher than in the north of Sweden. So it's difficult for us at the moment to find renewables projects that we can invest in, given that the pricing. But I hope that would change going forward, and that we can also be active in the renewable space and make investments work.
Charles, how do you meet all these requirements, sustainability requirements that is present in the, well, especially here in the Nordics? You have a huge demand for green financing, and how do you make sure that you meet all these sustainability requirements?
The question is not how we meet them. For a French fund managers, which we are, it's a regulatory obligation. Mm-hmm. Maybe you're aware that our today French president, when he's positioned as a finance minister in 2015, pushed a law to make sure to enforce every fund managers and every funds as well of more than 500 million euros to report specifically on ESG. It's what we call in France the Article 173 obligation. Mm-hmm. So everywhere we must report on our ESG obligations, what we do, how we do it, and not only as a fund manager, but also, as I said, for every fund we manage. So it has completely shifted our business in France, and I understand now the European Union with a new taxonomy to come to force by year-end has sourced most of its of the ideas of this French law to expand it further to Europe, which I think is a good thing. Mm. But beside the things about ESG and how much we should report, you should not forget as well that in infrastructure we made ESG before ESG exists, just because we invest in assets of a very different nature to standard companies. We invest in companies which make the good for everybody, which have a public mission, which is to deliver the water, to deliver the electricity, which is a commodity which is essential for the population, and which usually is operated under a monopoly. Because company is operating under monopoly, there is a number of laws to protect the users, to protect the general interest, so that the service is made at the highest standard for the lowest price, without the private operator using its bargaining power as a monopoly to extract extra value from users. So we need, as an investor, whether you invest in debt or in equity, to make sure that all this regulatory framework, but also the interaction with users as the interaction within the employees of the company, are sustainable in the long term. And this is everything which now is captured under the ESG acronym, which is probably reviewed today in a more professional way, with a methodology which makes sure that you do not forget any criteria in ESG before investing. So I think it's good, but it's not something which is very new to fund managers, that every good fund manager has already experienced for a very long term.
Mm. How many people do you have on your team focusing on the ESG issue?
All people. It's okay. Part of our DNA.
So there's no specific team doing that. It's just
no. There is no specific team. I mean, it's first it's a duty of every fund manager.
Yeah. To
make it. We have 20 fund managers based in Paris. The reality is that we also make sure that we have always the same methodology used across the management company, So we have one person specialized and head of ESG, making sure this methodology is that we have developed our internal models for ESG analysis is respected for every investment, but also monitored carefully within the 67 investments we have in portfolio.
Can I, Charles, just a question from my end. Do you have
Yeah.
anything that you don't invest in from an ESG perspective? Do you have any exclusion criteria?
No, we don't have exclusion criteria. The reality is that we have never invested into coal. But it's more because it's not a sustainable commodity anymore, and that in terms of economically, you would take a big risk than because we will not invest in coal. I think you need to be very pragmatic. There are a number of things which should naturally be excluded for any investor, and some things which you should consider maybe in a specific context. Let's take, for instance, in consideration gas. I mean, people would say you should not invest in carbon. Yes, the reality is that if you want to develop renewable energy, especially wind power and PV panels, you will have to manage intermittency of the power generation, unless you are ready to use your TV only when there is wind or sun, and you do not watch TV anymore when there is not a sunny day. So you need to manage this intermittency, and in our view, the best solution for managing intermittency today is gas. So we are very happy to finance this industry, not only in terms of power generation, as long as it is contracted under a power purchase agreement over the long term, but also gas storage, which is the only way to adjust the need and the supply of electricity to the demand, which, as you know, is highly volatile, not only intraday, but intra-hour.
So looking ahead, what do you see as the major opportunities and challenges with infrastructure going forward? I can point that question to you, Charles, first.
First, the infrastructure markets reflects the evolution of our society. Because our needs are changing, in my view, it offers new prospects, particularly, as we said, in the renewable energy sector or in the digital sector with telecom towers or with optic fibers or data centers. We are all confronted as well with major challenges: demographics, urbanization, globalization, and just as an anecdote, between 10 and 15% of people born in the 1970s could live to be 100 years old, which is 10 to 20 times more than 20 years ago. Which means that it now poses a problem of public health and collective management of dependency among our elderly people that we did not know 20 years ago. And this is something we must work on in the future in the infrastructure sector, because it's a public mission for collective needs, just as it is essential to work on the development of fiber optics in the territories to ensure broadband access to businesses and individuals.
Johanna, from your end?
I have to echo Charles on that thing, on when it comes to urbanization and the demographic pressure. I think that's one thing that would, and then also when it comes to dry powder, there's a lot of pension funds and other fund of funds that wants to come into the infrastructure sector, and that gives a lot of pressure on pricing and also quality. At least what I've seen during this 1.5 years is that it's come in a lot of managers with a very poor track record, and they've done separate accounts, and they want to get into the renewable space, and they especially want to get in quite early on as well, more on the greenfield side, and that makes it difficult for someone like us who haven't been in the industry for so long to really make sure that we're partnering with the right manager and with the right projects. So I think that is a challenge from our end.
Mm-hmm. I have one final. Yeah.
Maybe if I may, Jonathan.
Yep.
I think I fully agree with you, because if you look at how the asset class has developed over the last 10 years, of its expansion. I mean, it's been an amazing success, infrastructure. And you see more and more infrastructure investors, institutional investors looking for an allocation into infrastructure. Probably because infrastructure has delivered the value that everyone was expecting and was promising, but also because it's seen today as a safe bet compared to other asset classes, especially real estate or private equity, which are more cyclical and therefore more volatile. But the flip side of the coin as well is that we have seen a lot of capital allocated to value-add fund managers in the infrastructure sector, to some extent that today these strategies are not necessarily what we believe is infrastructure, meaning financing essential assets, and is more in competition with LBO players. And in my view, this is something which maybe with the COVID crisis, some institutional investors will recognize and maybe will want to fly more to quality and to what is essentially infrastructure, which is a core segment. The second element as well, when you are looking at the capital raising in our industry, I think around 80% of the capital raised last year was for only 5 fund managers, meaning that most of the fund managers, the successful fund managers, have been managing very large funds. I mean, I don't want to give free advertising, but everyone will recognize the big names of our industry, which have mega funds, as we name it, of 5-10 billion euros, which also means that these fund managers now are looking only at large companies, at trophy assets, which is good. The problem is that there is an imbalance between the number of mega funds and the size of these segments of large deals, when 80% of our industry are mid-sized companies. So there is, as you said, there is the main problem is to understand where is the market, where is the demand for capital, and please don't forget our SMEs, because most of the infrastructure companies are SMEs. So there is a lack of supply of capital for mid-sized companies.
No, but I have to just add to that I really agree when it comes to it. It hasn't been a good market, and we can see that it has been since 2009. And for us, when we meet a lot of managers, we really have to look into the track record and see how did they make money and how did they create their returns. Does it come from multiple expansion, or does it come from cash yield? How they grow their EBITDA, etc. And I think that was more really important element, because we can see that some have just only grown on multiple expansion and they haven't really created so much value into the company. And so that's one thing. And also, given that I have invested a lot in real estate before, and we have this so-called social infrastructure space where you have hospitals, you have senior housing, etc. That used to be a real estate asset class, and we are invested in senior housing in the real estate portfolio, where we see much higher returns than we see in the infrastructure space. And in the infrastructure space, you also take on operational risk, which is very interesting. So you have higher risk and less return compared to the real estate sector. And that's just only because you're adding the label infrastructure. And then everyone is so sure that this is secured long-term cash flows. This can return this and that. And when you're looking into real estate, they have to give you at least 2 to 4% higher return. So that's something that I find interesting when I sit on two shares, focusing on the infrastructure and real estate.
I have one final question, and that is really for an investor that looks to go into infrastructure, what would be your advice to that person from the both of you? We can start with Johanna.
Yes, I think that one advice for me would be that quality really varies. And that was, as I mentioned earlier, that we have seen a lot of managers with track record just a few years back, and most of it comes from a really good market, and I haven't really, to be fair, created so much value. So quality varies. So take a step back and meet as much managers as you could, and really try to understand what have they done for these companies. How did it, does it come from value creation? Does it come from M&A activities? Does it come from financing? How did they create this value? I think that's really key to success in this business. And then also when it comes to ESG, I would say that really varies when it comes to different players. When I see some of these very large houses with very large funds, and they've been around for at least a decade, when you start negotiating with them as an LP, given that I've seen a lot of agreements coming from the real estate space, I can also see that they're, to be honest, quite unmodern. So they're saying that they're focusing on ESG and it's highly important for them, and they're not going to invest in coal, etc. But when we're putting a side ladder or we're negotiating on some investment criteria that we just can't accept or prohibited investments, they can't sign off on it. Mm-hmm. Because they want to have the flexibility and they want to have the ability to do basically everything. And that doesn't work for us coming into this sector. So we have had to say no to a lot of these large institutional funds because they just don't want to change their side ladders and their pay. So I'm a little bit afraid, to be honest, in this market, that given it's so hot and everyone wants to be in the sector and they want to be with the big players, that they just accept the agreements there is because they're afraid of negotiating it. And it's so important when it comes to ESG to be able to change this world and to also improve it, that we are putting in these different things into the side ladder.
Charles, from your end?
If you just referring to what I said earlier, infrastructure is whether you invest through debt or equity, is investing into assets of a very specific nature. This is not private equity exactly. This is not private debt exactly. These are assets which are embedded in our society, and therefore which do not necessarily work as any company. So it's a specialty. It's a specialty, and you don't improvise yourself as an expert in infrastructure like maybe you could do potentially for real estate, for private equity or private debt, because it's more general. Our job requires specific technical skills and above all experience in the sector, experience of economic and financial cycles, political sectors, and different regulatory situations, so that we can project and anticipate the investment situation that we see. And I would say, as an anecdote, people who start their careers in infrastructures have usually difficulty getting out. And if you're just looking at me, I've been working in the sector for the last 25 years, I have no desire to leave it. Meaning that it's a specialty business, and for any institutional investor looking at investing in infrastructure and not necessarily understanding very well the sector, he should find a fund manager who is not only capable of deploying his capital efficiently, but also a fund manager who is capable of assisting him in understanding its needs and proposing him the best situation, but also a fund manager is able to explain him over the investment life and having a good reporting, a good pedagogy to explain what are the risks he's taking, how we are managing this risk, and what he should expect as a performance. And not only in terms of financial performance, as you said, ESG performance as well. So it's really more than any other sector, a sector where education and dialogue with your clients is absolutely necessary.
Charles, Johanna, thank you very much for joining the call.
Thank you.
Thank you.